Now we'll talk about the bank references. This may not give a lot of information, but they tends to use a series of standardized replies. An experience of this indicate the relative credit grading of the customer in question. Reports published in trade journals or the financial press dealing either with the customer company or with the type of business in which it is engaged. In assessing the theoretically, there are three possible ways of doing it. Now we will talk about the waiting incoming orders. The amount appearing on the customer's ledger account at any time will, of course, result from invoicing order he has picked. Now we will talk about the credit and collection procedures. In the previous section, we considered the firm's overall credit and collection policies. In this section, we shall discuss how these policies can be applied to individual accounts. In this section, we shall first discuss sources of information and then the decision to grant credit. Finally, we shall look at specific procedure that could be utilized to collect delinquent accounts. Source of information. An individual or firm is requesting credit. What sources of information are available to judge the credit worthiness of the applicant? Sources that can be utilized are financing statements, bank references, and credit bureaus. Now we'll talk about the financial statements. A vital source of information is the applicant's financial statements. An applicant who is in a financially sound position would have no hesitation in making available his or her financial statements. Inheritance interim reports, if available, are more desirable than annual reports. Audited and CPA certified reports are preferred to unaudited reports. The financial statements are useful for calculating various liquidity leverage, efficiency, and profitability ratios that may be used in evaluating credit risk. If the firm is using a credit score model discussed later, or if the applicant is requesting a large amount of credit, financial statements are essential. Now we'll talk about the credit bureaus. Credit bureaus. Credit bureaus specialize in consolidating the experience of other firms with the applicant. Credit bureaus compile a history of the applicant's credit payment performance as reported by the credit granted firms. Financial information on a credit applicant may be obtained by credit bureau member firms who agree to provide credit bureaus with information on their clients. In addition to these information sources, a firm may try to comply its own information. It may have its sales personnel prepare a report on a credit application applicant. Alternatively, if the credit request is large enough, it may send a credit department employee to visit personally with the credit applicant and garner as much financial information as possible. Credit analysis and credit limit. A firm reviewing a request for credit needs to judge the credit applicant willingness and ability to pay. If either of these two factors is missing, the firm would increase its chances of suffering losses on credit extended to the applicant. Willingness to pay is judged by the firm's past financial performance. Its ability to pay is judged by the strength of its financial statement in relation to the amount of credit desired. Either heuristic or statistical procedures could be utilized in credit analysis. Now we will talk about the credit requirements. Right? The first factor is applicant credit requirement. C. This factor is measure of the applicant dependency on the creditor. If the applicant if the applicant plans to buy less than 25% of his requirement from the creditors, he gets 0% percent toward his credit line. If he plans to buy between 25 and 50%, he gets a 5% allowance. If, if the plans to buy over 50%, he gets a 10% allowance. Now we will talk about the heuristic approach. The heuristic approach described here is based on a manufacturing company's actual experience. The formula or procedure described here has the weight of marginal managerial experience and institution behind it, and therefore is heuristic in nature. There are 8 factors that need to be considered in the decision to establish a credit limit and grant credit. The credit limit is the maximum amount of the credit purchases allowed credit applicant at any one time and is stated as percentage of tangible net worth. The lower limit is minus 50%, 15%, and is tantamount to denying a new credit to the applicant. The upper limit is 80% and equivalent to the sum of the maximum percentage point on the 8 credit granting factors. Now we will talk about the pay habits. Pay habits. The second factor is pay habits and is a measure of a willingness and ability to pay. Payment during the discount period rate 10%. Payment during the credit period are worth 5%. Habitually, habitually, late payments rate minus 5%. Now we'll talk about the years in business. The third factor is years in business. Why? Is the is a Measure of ability of the firm to pay. Being in business less than 3 years has no effect on increasing the limits. If Y is between 3 and 10 years, the limit is increased by 5%. If the firm has been in existence for 10 more than 10 years, it raises 10%. You can you can see a chart here. Currently, we are unable to read this chart, so we will talk about the paragraph profit margin. The fourth measure is the profit margin. M. If margins are less than 5%, 0% is contributed to the credit limit. Margins in excess Margins in excess of 14% contribute 10% to the credit limit. Current ratios. The fifth measure is the current ratios R. A current ratio of over 2.22 to 1 is considered to be a good indication of ability to pay and helps contribute 10% towards the credit limit. A current ratio of less than 1.5 by 1 is considered to be relatively weak and does not help increase the credit limit. A total debt to asset ratio. The sixth measure is the ratio of the total debt to total assets T and represent the ability to pay. If T is less than 30%, the applicant is viewed to be conservatively leveraged and added 10% to the credit limit. On the other hand, a T of over 50% implies increase the financial riskiness and rest rates a minus 5% towards the credit limit. Now we will talk about the inventory turnover. The seventh factor is the inventory turnover I. A higher inventory turnover implies the high efficiency. It can help contribute anywhere from 0% 0% to 10% towards the credit limit as shown in table 5. Quality qualitative qualitative factors. The last factor is qualitative factor Q in the and lets the credit manager use discretion in subjective evaluation of the credit applicant's willingness and ability to pay. It should be kept in mind that the Factor mentioned here, factor mentioned here, and their contribution to the credit limit are based on a particular firm's actual experience. The factors and their contributions to the credit limit may vary from accounts payable, and the economic environment would also be considered in developing in heuristic credit evaluation decision model. As an example, we apply to the heuristic model presented here to evaluate Kartik metal. Assume that Kartik is requesting a credit line to buy less than 25% of its raw material requirements. What is the maximum credit line to establish for Kartik? The contribution of the various factors to the credit limit are shown in table 6. The last factor Q is rated average. You can see here, you can see table 6 here. There are three sections: factor section, Kartik's rating, and contribution to credit limit percent, right? There are 8 points. Kartik's requirement C for Kartik rating, it's C less than 25%. And, I will talk about the factor, Kartik rating, and contribution to the credit limit in percent respectively, right? So Kartik's requirement C C less than 25%, 0. Second point is Kartik habits, pay habits, P. Tax discount, 10. Third point is year in business, Y is greater than 10. 10. Fourth point is profit margin, M is equal to 4.6% less than 5%, 0. 5. Current ratio, R is equal to 2.89 greater than 2.5, 10. Sixth point is total debt to total assets, T is equal to 0.28 less than 0.3, 10. Inventory turnover, I is equal to 12 greater than 10, 10. Eighth point is quantitative Q is average, 5. Total contribution is 55. Here point A is based on sales rupees 177, 250 upon rupees 14, 619 is equal to 12. Karthik's credit limit is rupees 42, 961, 0.55 is equal to 23,600. Additional credit for Karthik is equal to rupees 23 minus rupees 7,500 is equal to 16,100. Because of Karthik's dependence on only 12 customers, total contribution of the 8 factor to the credit limit is 55% of the tangible net worth, or rupees 42961 multiplied by 0.55 is equal to rupees 23600. Since the existing credit lines total rupees 3000 plus 2500 is equal to 7500, Karthik can be extended additional credit up to rupees 23600 minus rupees 7500 is equal to rupees 16100. Now we will talk about the statistical approach. In quantitative approach to credit analysis, the firm relies on financial information as well as on the payment record of firms it granted credit in the past. Past customers can be readily classified into good risk and bad risk categories. The financial information on customer is used in conjunction with a statistical procedure called multiple discriminant analysis to develop a statistical credit scoring model. Discriminant analysis analysis first of all provides an indication of those measures which are most important to distinguishing between good risk and bad risk customers. That is the first firm may start out using 30 ratios and various variable in its analysis. This discriminant analysis might indicate that only five of these ratios and variable are important to in characterizing good risk and bad risk customers. Second discriminant analysis will develop weights for each ratio or variable to form discriminant function that may look like discriminant score is equal to 3.5 multi current ratio plus 1.7 profit margin plus 7.1 debt to assets plus 1.9 quick ratio plus 0.3 inventory turnover. The 3.5, 1.7 and so forth are weights developed by discriminant analysis. Current ratio, profit margin and so forth are discriminant variables identified as important by the model. The sum of the products of the weights and the variable is the discriminant score. The analysis selects weights as can discrimination between good risk and bad risk account is maximized. A perfect set of weights would create a discriminant score such that all bad risk firms would have scores on the one side of the discriminant score. Once the discriminant scoring model has been developed, it can be applied to credit applicants. The weights can be used to calculate a score for the credit applicant. The credit applicant score can be compared with the discriminant score to see whether the applicant falls in the good risk or bad risk category. If the applicant falls in the good risk category, a similar type of procedure to that described here can be used to establish a credit limit for the applicant. A variety of collection procedures can be utilized by the firm in its efforts to collect on delinquent accounts. The initial efforts should be very low key and should become more strict as per response from debtors. If payment is not received within a few days, one or two follow-up letters should be sent demanding payments. Now I will talk about the personal call. Some firms have either collection personnel or sales representative visit delinquent debtors. The firms feel that face-to-face confrontation with a delinquent debtors provides them with a edge or other creditors. Telephone call. If letters are unsuccessful, a credit department employee, preferably the manager, should call the delinquent debtors and ask for prompt payment. The credit manager may also wish to communicate that legal action may be taken if payment is not forthcoming. Collection agency. If the preceding measures are unsuccessful, the firm may consider the services of collection agency. The collection agency fee is typically high, usually 50% of the amount collected. For small delinquents, accounts, this may be only feasible alternative. Legal action. A legal action is usually costly and there is no guarantee of payment. If a firm is in a very weak financial position, legal action will force it into bankruptcy. The firm may choose to use legal action as a negotiation tool to deal with large delinquent accounts with a very large delinquent account. The firm may use the threat of legal action to appoint more competent management. Now we will talk about another topic, cost of credit control of this chapter. Cost of credit control. The cost of credit control include the cost of accessing and reviewing creditworthiness, sales ledger keeping and invoicing, checking incoming orders, and debt collection. These costs these costs may occur in various departments of the business, but there should be some means to of identifying them and collecting the total cost, which will have to be taken into account in reviewing the benefits of the credit policy. talk about the cash. I will talk about the cash discounts. Now we will talk about the cash discount, an alternative or supplement of a former credit policy is to offer discount for for prompt prompt payments. In considering this possibly, it is important to bear in mind that a customer who normally pay promptly will now become entitled to discount, although there will be no improvement in the timing of their payments. Point B. Some late payers will nevertheless deduct the discount from their settlements. And there may be some practical difficulty in recovering these incorrect deductions. There are various other ways in which a business can speed up its collection of cash without requiring the customer to pay any earlier. The most common examples are by using bills, discounting, or factoring, both of which have been mentioned earlier. Personal guarantees. An alternative form of protection against bad debt is to take a personal guarantee in support of the customer's account. The value of personal guarantees varies considerably and they are likely to present two problems. It may be more difficult to assess the creditworthiness of an individual guarantor than of the trade customer. The guarantor does not normally expect to be called upon to pay, and there may be difficulties in obtaining money from him when the need arises. These problems do not occur to the same extent when the guarantor is another company. Often the parent company is the customer's group. So the objective of receivable management remains as the most effective way to receive the cash back without sacrificing the sales and future prospect of the company. Factor, Factors affecting policies for managing accounts receivables. There are several effects of extending credit to the customer on various operating parameters of the company. These includes first one is revenue effects. As a customer or extended credit payment for goods is received later, giving the customer time to generate sales from the goods and pay back to company. This may allow the company to change the higher price and also quantity sold may increase. Second thing is cost effects. Extending credit means that the company has to maintain a credit department. This involves costs. Also, collecting receivable has its own costs associated with it. The cost of debt. If the company has to extend credit, it must finance these receivables from its own money or from borrowing. Both of these methods involve costs. Now we'll talk about the probability of non-payment. The company always gets paid if it sells for cash, but if it extend credit is there is a probability that the customer may not pay. This means that the company may not get its payment, resulting in a loss to the company. The fifth point is the cash discount. The cash discount affects pa- payment patterns and amounts that the company receives early. If the cash discount is high, then there is higher probability that the company will get more cash upfront and vice versa. Thank you for watching the whole video. The chapter is now the chapter management of receivables now is over. And now, if you if you think it's useful, then please like, comment, and subscribe our channel. Thank you for watching the video.